All right, everyone, and welcome to part 6, PivotBoss Pivots of the 10-part executive training series. I am Frank Ochoa, aka PivotBoss. I'm super excited to bring you this on-demand training here for PivotBoss Pivots. PivotBoss Pivots is one of my favorites. Obviously, it bears my name, but I wouldn't have put my trading name here on a set of pivots if I really didn't believe in it. I remember many years ago when I was testing out all different types of pivots and using them on my screens, putting them through their back test paces and putting them through just decades of data in both futures contracts and also stocks and all different time frames. I remember thinking, man, it would be really cool to come up with an amazing version of pivots that people can use that I created. And because, I can take the best of all the different worlds and create something even better with them. And that's what I was able to do. I remember when I was first tinkering with the approach to PivotBoss Pivots, assembling the data, the information just in the way that we have makes things so much cleaner, so much easier. There's not any kind of fancy equations or any kind of craziness that's going on. It's pure market-generated price information, the way that the traders have looked at it for a long time. So it analyzes all of the stuff the way that you would want to. I mean, with the ability to identify trapped buyers and sellers at key previous high-low close levels, or identifying extensions based off of the previous range. This PivotBoss Pivots indicator does a whole lot of fantastic things. So without further ado, let's go ahead and get started with part 6 of the executive training series, PivotBoss Pivots. So many of you may have already seen this slide before. Basically, this is kind of your cheat sheet for how the PivotBoss Pivots are calculated. Very simple, straightforward approach. Basically, there are 3 types of pivots on here. You have the expansion targets, which are above and below the key range. You have your previous range data here, and that previous range data is all based off of the previous range of data that you're using to calculate the pivots for the upcoming period of time. And so you have the previous high, low, and previous high, low, and close information. That is one set of previous range data. Very important to understand the previous high, low, and close, because those mark the important key levels of any price auction. So it's important to know those levels. And then the inside levels are going to be the pivot range. So the pivot range is what helps to combine a whole lot of different styles of pivots together, because with the pivot range, you're then able to incorporate pivot width analysis, pivot trend analysis, value relationships, and the such. And then when you're looking at the previous range data here from previous high, low, and close, you're able to identify who is attempting to influence the price action at those key levels, and then you're able to establish whether one set of market participants is winning and the other set is losing, or how it's playing out, and then you can judge your trade accordingly. These expansion targets are obviously based on the previous range here. So all of these formulas basically tell you what's going on. It's very simple. So in order to get the 100% upside level, which I call R, resistance 100, and S, support 100, in order to get that, you just take the range from high to low of the previous range, and you project that same figure upward and downward, and that gives you the 100% expansion targets. From there, 50% of that range projected would give you 50. You have 25 and 75. So basically, you just see expansion every 25% increment. If you needed more targets beyond that, obviously, just add another set, of targets. This thing can forecast as far as you want to go. And in live trading, I've seen these things go to the 300%, 350% targets before, so they've really gone way out there. And if you need more targets, all you got to do is just forecast it out there. So this is a very easy approach to calculating pivots, but it's a very powerful form of pivots, because of the many things that you can do with it. The most important part is that it's based on the market-generated price movement, and that's important. So being able to identify, for example, any pivot, like the floor pivots, for example. Floor pivots, that's basically based off the previous high-low close information, right? And then that gives you the pivot point here. Previous high, low plus close, high plus low plus close divided by 3 gives you this level. So previous high plus the previous low plus the previous close divided by 3, all of that divided by 3 gives you the daily pivot point. And that's important, right? But then when you calculate the rest of the floor pivots, you know, it's a fancy calculation for R1, R2, R3, R4. But it never gives you any mention of the previous high-low close information, which if you plot those levels, it actually becomes much more meaningful than if you plot any of the other R1s, S1s. So, you know, that's why I incorporated these levels, because these are the levels where the actual battle is happening in the charts. So if you're paying attention to those levels, you can see who's trying to influencing price and who's going to get their stops run. Now, what I love about this indicator is since it's based on price, it's going to self-adjust to the market's volatility. So whatever this range is right here, say it's a very narrow range compared to average, then these targets are going to be closer because of that. And so you won't be playing to targets that are far outside the scope of the current market's volatility. So you're going to be playing to targets that are much closer given the recent price action and how it played out. If this range was really, really wide compared to average, then these targets will be wider accordingly. Additionally, what I love about this indicator, it's a completely leading indicator. I do not like indicators that lag. I don't like it that much, you know, and that's just a personal preference. Again, there are so many different ways to make money in the market. You can use any indicator you want, but I prefer to use indicators that are leading indicators. Leading indicator means that you know where that key level is going to be before price gets there and it's not going to change. You know that level is the key level. This level is already set in stone. The previous high, previous close, previous low, those levels are set in stone the previous week. So Monday morning or Sunday night or Tuesday or Wednesday or Thursday or Friday, as the market plays out, you know that that's the previous close, previous high, previous low. You know ahead of time before the market opens. That's a leading indicator. Additionally, this pivot range can be calculated ahead of time as well, so that you know the next day, if this was where the current pivot range closed this session, or for this session ended, and then the upcoming day, the pivots are going to be up here. Now you know you have a 2-day higher value relationship. That tells you that the market is trending higher, and you should be looking to buy pullbacks to the pivot range for a move higher. So that allows you to have forecasting abilities, and that allows you to plan your trade accordingly. The other thing about this, again, scalable to all time frames. Just like every single thing that I teach, you have to be able to use it at any time frame, because basically if you can't use it across time frames, then you vastly limit the scope of what that indicator or data can do for you. Being able to scale this thing from lower time frames all the way up and everything in between makes this indicator powerful. And when you drop into Thinkorswim, you have the ability to make daily pivots for like all of this for one day, or you can make them based on the hour. So every hour you get a brand new set of pivots, or 3-day rolling pivots. You can make weekly pivots. You can do 2-week pivots if you wanted to. And that makes it important because now you're able to really user define the types of opportunities that you want to find. Again, this has so many different ways, this indicator, that you can use it to analyze and trade the market, from pivot width analysis to pivot trend analysis, value relationships. You can use it for multiple time frame analysis and confluent zones, all these various things, and it makes it super, super powerful. Day session high, low close, or Globex. I like to use Globex. So ETH high and low is what I use, and basically I think that's the best way to go because it gives you all of the price and data information for that auction. But in my research, and again in my book Secrets of a Pivot Boss, I talk about the differences between ETH and RTH, and how in my research there really hasn't been a whole lot of difference between the two. They both have predictive abilities. You can use either or because traders use either or. But as more data and volume have filled up the stat sheets for overnight ETH trading, it's become more viable, especially as other economies come online as traders. So I do think ETH is the way to go, but you can do either, and it's your preference. So with that said here, let's go ahead and go to the second cheat sheet here, and that is basically your key opportunities cheat sheet. And basically, PivotBoss pivots are incredibly powerful and accurate, but they are this way because big money market participants engage these levels in various ways, including the use of algorithms. So that's why I believe that these the PivotBoss pivots is so accurate, so powerful, and head and shoulders above most, is because I do believe that it's the programs, the algos, the institutions that all program to these levels and create these strategies that almost create a sort of self-fulfilling prophecy. Because they trade at these levels, you're going to see action at those levels. So why do PivotBoss pivots work? Because algorithms help to influence the power of PivotBoss pivots. The savvy traders, from floor traders to institutional traders, have been using key levels like previous high-low close to trade for decades. So what happens? Well, whenever you start to get programmers developing algorithms, they're going to ask traders, what's the best strategy you have at finding opportunities? Well, they're going to program those strategies into the algorithms, right? That's what they're going to use. So finding traps at the previous high-low close, finding expansion, those types of things are programmed into these algos, and that's what begin to use. That's what these institutions and traders begin to use to engage the markets. So it's something that's been played out for so long, the use of key range analysis and identifying if we're going to see expansion from that range, etc. Well, this is the exact same type of thing that you can use. I mean, these pivots allow you to engage the market in so many ways, and you know and can feel confident that price will react to those levels because there is such heavy participation at those levels. So having said that, I wanted to bring some key trading opportunities to the forefront of your mind here. So as we use PivotBoss pivots, these are a few. I have 5 ways here to engage the pivots for potential trade opportunities. The first way is to use the previous high-low close and watch those key levels for bull and bear traps. So trade bull and bear traps at previous high-low close would be the first key trading opportunity. So trapped buyers and sellers lead to high odds momentum trades with clear targets to play towards. So for the most part, what that means is if price tries to get to and through the previous week's high price and can't, and there's trapped buyers up there, the expectation would be that price would rotate from the previous week's high back to the previous week's close and the previous week's low. So you have high odds momentum reversal plays, and then you have clear targets to play towards, which are the opposite sides of the key high-low close range. So playing those bull and bear traps, whether it's at the previous high, low, or close, can help with identifying the next major momentum move. I know traders that all they do is try to run those stops and look for traps. They don't try to go with the flow. And we saw that today when we were looking at the ES as algos were defending the volume point of control. They did it on 3 rotations, weren't getting paid, and then you saw the buy stops come out. So one of the ways to do this would be to look to trap those bears, and instead of trapping at VPOC, you can look to trap at the previous high, the previous low, or the previous close, and use their stops as fuel. So trading bull and bear traps would be number 1. Number 2 would be fade the 25% expansion level on first test. So what I notice oftentimes is that the 25% expansion level is a level that sees swift reversals, high opportunity reversals off that zone, because when price sees expansion through the previous high or through the previous low, price usually goes to that 25% expansion level, and that 25% expansion level then becomes a level that those market participants use as a profit target, right? So since this level is used as a profit target, you can see swift reversals occur off this level, which invites counter trend traders. So because we know that if you see expansion to a 25% key level, you usually see that as a profit target for anyone that took that expansive move. Well, then you would usually see at the 25 level, you're going to see algos and program traders come in and fade that level back to the previous high or low range. And that's where part 3 comes in. Defend a retest of the previous high-low after a move to the 25% expansion level. So if price sees expansion, say through the previous high, and you see expansion, let's just draw something real quick. So here's the range right here. Okay, there's the high, there's the low. If price sees a move through the high here, the previous high, okay, and price goes through it, and here's the 25% key level, when price comes back to see a defense or sees a retest of this level, that's where you're looking to defend for a push higher. So basically that's what part 3 is about. It's about defending a retest of the previous high or low after a move to the 25% level. Because very similar to fading the 25% level, when price comes back to the previous range, you're usually going to see defendants come in and defend that zone. And then you're also going to see profit taking of those that took the 25% fade. So you're going to get a double buying or a double dose of selling at that level, depending upon market direction. Number 4, look to play for expansion when the pivot range is narrow. So this is pivot width analysis. So when the pivot range is less than 25% of its average size, that usually lets you know that you're about to see some type of expansion ahead. So when the pivot range is extremely narrow compared to average, look to play for expansion at some point, and then from there you have your extension targets to play to. And number 5 here, look to defend reversals to the pivot range during trending markets. That's very similar to what I always talk about. In an uptrending market here, you want to defend pullbacks. Responsive bulls will defend pullbacks to the pivot range, and then responsive bears will defend pullbacks in a downtrending market to the pivot range. So basically those are many of the key trading opportunities that you can use with the PivotBoss pivots right now. And as a matter of fact, there's several trades within these trades as well. For example, trade bull and bear traps at previous high-low close. Each of those has their own nuances at trading a trap at a high versus trading a trap at a low versus trading a trap at close. They each have their own nuances and tendencies, and obviously this is what we'll use and talk more about in the PivotBoss Premium Trading Room. So now that we have these to look to, you can again use this as a cheat sheet that you can print out, put it next to your computer here, your trading machine, and then we can move forward with it and use it every day. So let's drop down into the intraday time frames here. All right, here's market delta on the screen right now. I'm going to bring up, let's go with the ES for a moment. Here's the ES, this is a higher time frame. And in this time frame right here, what you see is I got the weekly pivots on there. So what I'm going to do right now is I'm going to take off, really that's all I have on here. So I'm not going to take off anything. Well, I can take off the previous week's high-low. Let's take that one off. Okay, so what you see here is previous month's high-low close. So that's the previous month's high. Here's the previous month's low. Here's the previous month's close. MHI, monthly high, previous month's close, previous month's low. Very simple. This is your pivot range right here. That's your monthly pivot range. And then you have the high plus low plus close divided by 3 is the middle of that range. And then since price closed below the pivot, then the top is going to be the midpoint of the previous range. That's why I love the pivot range, because you have the high, you have the low, and then this one right here is the exact midpoint of that range. And we already know how important the midpoint is. So we have a built-in midpoint via the pivot range in this indicator, which I really love. Okay, and then you have the edge of your range here. Obviously, there's your range. That distance right there, if you forecast that distance downward 100%, you're going to get this target. If you forecast 75% of this range downward, you're going to get this target right here, the 75%. Here's the 50%, and then this one right here is the 25% target, right? So that's what these are. It's just based off percentage range. And, you know, it's very, very simple. I mean, it's 25, 50, 75, 100. You know, you can go down into eighths, you can go down into sixteenths, very similar to what we were talking about with the key range before. These are all the same concepts, and they're all scalable in the same way. If you wanted to, I mean, obviously, this is all very similar to what you can do with fib extensions as well. So, you know, this is something like where you would see a 38.2, a 50, and a 61.8. You know, but it's the same type of extensions, only we're not using fib numbers. We're just using basic math numbers, things that are much easier to understand, and they actually work to these levels. So you can see those are the basic makeup of a PivotBoss pivots, and you know, right there, number 4, which was look to play expansion when the pivot range is narrow. This is what I mean. When the pivot range is super narrow, the width of this range from top to bottom, the previous width was from this top to that bottom, so that's how big it was. The width before that was here to here. Look how big that is. This one's from here to here. But look how narrow this one is comparatively. And that's what I mean before when I said the pivot range is super narrow. Look to play expansion. Well, here's the range right here. We saw the expansion here, and then there's the move. And here are your targets at each of those expansion levels. 25, 50, 75, 100. If you need more levels outside of that, you can add them as well, and you can continue onward if you wanted to. I usually find that having 100 is just fine, but sometimes you get a very, very exhaustive market, one that gets a huge rally or a huge sell-off or something of that kind, and you do need to add some distance to it, those pivots and those extensions, and that's fine as well. So this is what I mean by when you have a super narrow range. It's just if you have that narrow range, you want to be looking for some type of expansive event. On the contrary, if you have a super wide range compared to average, if we're calling this one average and we're calling this one average, look how wide this one is, look how wide that one is. This one's very wide, this one's narrow. So when you get a very wide pivot range, you should be looking to fade the extremes because you're likely going to see a trading range market develop. So this is basically the type of analysis that you would do with pivot width analysis in order to identify when the market may see some trading range or expansion ahead. So this is just important to be able to look at the market in this way and just get a general sense of how to do this. Now, let's bring up another chart here. Let's bring up crude oil. Now, crude oil shows a different part as well. This one, really, since this one's been trending, this shows us a great trending profile. And if we bring up our expansion targets, here we go. So in a downtrending market, where value is being seen at lower and lower price levels, this is the pivot range, and here's the pivot range the next month, and here's the pivot range the month after that. It's printing at lower and lower price levels. That's basically tell you that value is being printed at lower and lower price levels. That tells you that any pullbacks to the pivot range should be seen as selling opportunities for another round of weakness. So that's where I talked about before, where if you're in a downtrending market, bears want to defend pullbacks to the pivot range in a downtrending market to these downside targets. And in this case, crude oil went to the 25, 50, 75, and then bottomed out right at the 100. It got a little lower than it and then snapped back to the 50, and this is where it's currently holding. So very important the way this one's playing out right now. But in a downtrending market, you want to go in the path of least resistance. Trading pullbacks to that pivot range offers incredible selling opportunities. And on the flip side, you know, it can be the same can be said on an uptrending market. So if you're trending higher, then buying pullbacks or buying dips to the pivot range makes a lot of sense and can get you to those upside targets. Now, let's talk about trapping bulls and bears at previous high-low close levels. So let's take a look at, this is crude oil right here. And let's take off some of this analysis. So we're going to take these off. So here's the previous high-low close information on the charts. And we're just looking at that right now, okay? And if you just look at these points on the chart, and let's bring up a bigger chart here. And you know what I'm going to do is I'm going to take off value too. So I'm going to take off value, and all I have up here is just plain price with high-low close. So this is the high, the low, and this is the close, okay? And typically speaking, in an uptrending market, so say this is trending up right here, right? The next day, in an uptrending market, when price closes near the high, and here's the high right here, what the market participants are immediately looking at are, let's trap above the high and bring it back to the low. That's the first order of business that goes on right there. So that's a bear trap that happens right away. So basically speaking, if we just draw a crude drawing of this, up, down, up, down, up, down, up, right? Something like this. Whenever it closes near the high of that move, so the next day you're going to see the close here, the next day you're going to see the high here, after all of this trending movement, the first thing that happens is you're going to see bulls attempt to expand the range right here. You're going to see bulls attempt to expand the range beyond that previous session's high price, because holding above that high would imply more strength, right? Well, you've just had a massive rally. You've closed on highs. You know, it's been rallying for a couple of days and you close way, way up there toward the previous high. What usually happens instead is you usually see bulls get trapped up here as sellers, big passive sellers using limit orders come in up here and they reject the first move. So then price goes bid off the close and rallies and they reject a new high. So what do you know what happens when you get a new high that's rejected by a higher high? If price falls back down to here, you're likely going to take this level offered and you're going to drop it right into the previous low. That's the trade. The trade is, here's the previous high. You see the market's not able to hold above it, so it gets offered right back into the previous low. That's the trade. That's it. That's the entire trade. What happens from there, you can deduce more trades from there. For example, right here, price dropped down and then tried to get back above the previous low, and then that was a bull trap. That was a bull trap. So then you see a bull trap occur at this low. So if I come in and zoom in on that area, you can see the market had dropped through it, was holding below, and then popped back above the previous low. So this is the previous session's low. Tried to hold, no acceptance, and boom. These are trapped bulls. And then price comes back, lower high. That lower high seals them and traps them. And then you see the sell stops come out. These buyers were forced to become sellers in the down move. So this is a bear trap, a bull trap rather. So you see that trap, and then you see the one up top. So on this day, the previous session, you saw two traps here and down. Now you see right here, look at this little trap. That is a bear trap. So price pops below the previous low here, can't hold below there and gain acceptance, so it pops back above, and then it works its way back to the midpoint of the day. This was the midpoint of the day, if you recall, and this is the high, where it was then sold off and offered again. So if you look at just yesterday's chart, we had 1, 2, 3 bull bear traps to play. And that is all you need to do at times when you're trading based off the PivotBoss pivots. Look for traps at those areas. And then once you identify what could happen or how price may play out, you have additional analysis to play with now, because now I can bring up, the pivot range for the day. And then you can see how the pivot range influenced movement off those key levels. And then you can bring up expansion targets. Here's 1, here's 2, here's 3, and 4. And now you can bring in expansion targets above and below here. So you can see how this thing is played out, right? Very solid movement here. Very nice the way it's moved. You can see how the pivot range was important in this move. Just brilliant the way it all moved and played accordingly. Now, let's see. Let's scoot back a little bit here. Okay. So right here, this is another trap. This is harder to come by. It's harder to find and see, but it's something that happens all the time. Here's the previous close. You see that dotted line right there? That's the previous close, and price is trying to hold below that level, right? And it's being offered again and again and again and again. But price isn't going lower and paying. So when price pushes back above the close, you start to squeeze all of these market participants. And all of these market participants created a lot of volume there. You see how much trading range there was there? All of this range, all of this range, all of this range. All of those market participants were trying to hold price below this low and establish acceptance. And when it failed here and price went squeeze, when it came back to the close, this is where they trapped them finally. And then you see a huge move ensue toward the 25% expansion target. This huge move was essentially fueled by all of these participants. So the bigger the trap above or below a key level here, the bigger the resulting move that can occur. The idea is for you to identify who might be influencing that move right now, who is defended where, and are they winning or are they going to lose? Because if they get squeezed here, you don't have to get in here. Put your limit right here and wait for it to come to that limit. If it fills, it's likely going to be a great entry. If not, you don't have to go far to know you're wrong. And if it does fill, you're likely going to get a quick move in your direction to get quickly scaled. And from there, you got nice trade to allow to work out in your favor regardless of where it goes. The first move, if you're going to squeeze off of the previous close higher, the first move is going to be to the previous high. And we got it, and price traded around that level. This built up the fuel for the last move into the top. So that's what another trap looks like. We can keep scrolling through here. If you come over here, basically what's happening here, okay, say for example, here's the previous high, close, and here's the low, okay? Price goes offered at the close. This is an after hours trading, right when the market reopens. That's why I say when the market reopens after it closes RTH session, then it reopens after hours trading, look to see what happens. Because what happens at the previous close can tell you a lot about what's going to happen in overnight trading and perhaps how that can affect the upcoming day. When you have right here is price went offered at prices above the previous close, that's an immediate indication that you're going to likely go offered through the low or back to the low. Since they're so clean and so close, you see price go offered through it, and then when you come back, look how clean the defense is back at the low, and that leads to expansion to the downside. When price gets expansion to the downside here, you see it's defended off the 50 and pushed back up, but any return back into this previous low here is likely going to be defended for a move down. That's the idea here. All right, here's Thinkorswim. A lot of if you bring up, I know you can't see this, you'll see it on the recording. We have the parameters dialog box here. What I can do is bring up, for example, daily pivots. So now on the intraday chart here, we have daily pivots that we're looking at. So what happens here? This is the ES on these pivots here, price being offered at the previous session's close and drops down, and then bounces here, comes back to the previous close, finds a higher low, and starts to work its way higher. That's just kind of how it's playing out today off the PivotBoss Pivots. It's trying to hold above the top of the pivot range for a shot at seeing a continuation into 1904. Now, what I can do is I can bring this up and actually add all of the pivots for the range. So I can bring this back and I say, oh, look at this. Okay, now I can look back to historically and how price has been playing out to these pivots. and gauge to see how things have played out in those areas. I would say in a downtrending market, obviously you want to focus to selling pullbacks in that market. So you want to focus on tracked buyers and sellers that will help you get to that end. In an uptrending market, you want to pull back to the pivot range and buy it. Pull back to the pivot range and buy it. This one is what you want to do here, but it just didn't work out until it failed. So that's usually the course of action. Now with the Thinkorswim pivots, if you double click these right here, you can bring up intraday pivots that are phenomenal. For example, you can bring up hourly pivots based off of the 1 hour time. So if you look right here, you can see it. So I can drop down, say, into a 5-minute time frame. This is a 5-minute chart with 1 hour pivots on it. And you'll be amazed by looking at these pivots how phenomenal these pivots react hour to hour. So this is just a 5-minute chart, and you can see the hourly pivot range trending lower. And what did I mention before? You want to sell pullbacks to a pivot range in a downtrending market. Then it comes up, you want to sell that pullback to the pivot range in a downtrending market. Here's a pullback to the pivot range in a downtrending market. Pullback to the pivot range in a downtrending market until this happens. And if you read my book, Secrets of a Pivot Boss, we talk about this phenomenon right here, where this pivot range right here is lower than this pivot range, and yet price closed and opens rather above the upcoming pivot range, which changes the bias of what's happening in the chart. So when price rallies up here and pulls back to the pivot range, it then becomes support, and then you see a move higher. Once you see that move higher, pullbacks to the pivot range in an uptrending market become the word right there. Pullbacks to the pivot range, right? So you can see how now these pivots can be used in any time frame using any style charts. And again, you can drop this down into even lower periodicities if you wanted to, and do, say, I don't know, 30-minute intervals or something like that, where now you're making pivots every 30 minutes if you wanted to. I mean, any of these can work and do work. You just have to find a set you like and use them. For me, weekly, daily, monthly are cream of the crop, but you also have 4-hour pivots and hourly pivots that do phenomenally well. So this is just awesome. So now if you come in here and you bring it back out, you can bring it back out to a monthly look as well. And now this will give you monthly pivots on the intraday 5-minute bar. So now you can use the monthlies if you wanted to on an intraday bar if you were so inclined, because now you can find moves off of those levels. I mean, this is intraday movement. If we bring this thing out back to a 15-minute time frame now, right here. Now let's go a little higher. Let's go 60-minute. There you go. Then you can start to see, if you're using 60-minute charts with monthly pivots, you'll start to see more of the action and how it influences. It went offered here. It drops down into the low, bounces, then it can't hold, so you see movement downward and then back and then so you see the movement there. These are monthly pivots right here. A lot of the action happened here, and then from there, it was expansion. But sometimes monthly pivots, you get so far away from these pivots that you don't really have access. Like all in here, there was really nothing to do other than, I guess if you squeezed from here, you're playing to here. Then when price came up, you're trying to get this up to here, and then so you can see it's tracking. But by bringing up the pivots here and shifting them to a weekly time frame, the weeklies will give you a lot better idea of what's going on in the short term off of the key levels. And this is kind of what I was talking about before, where look at this downtrending market, downtrending market, downtrending market. Sell here, right? Sell here. But now look what happened. Price closed here last Friday above this week's pivot range. And then it opened above the pivot range. So when price dropped into the midpoint of last week's range, it was defended back up. Now you have the market being bid off the pivot range when it has been offered for 3 weeks. So I believe, as I said before, that I think that this squeeze will continue. and now you're about to see a squeeze where we're about to see movement higher off this pivot range. That's easily going to lead to the 25 or perhaps even higher into the 50% expansion target. So that's what I would be looking for now. It's these subtle nuances of how things play out around these levels that really help you gauge whether something is really about to happen. And that's what this is all about, is really get into the nuances of what's happening around these levels. So these weekly bars or weekly pivots is usually what I'm using when I'm looking and studying the charts. And then I'll go to monthly as well for other things. But I like the weekly because it gives you much more immediate levels and key levels. But you have to defer to the monthly as well because the monthly patterns and levels hold higher significance. All right, I want to say thank you all for joining me for part 6, PivotBoss Pivots of the 10-part executive training series. We covered a whole lot of topics here, and many of them directly correlate to making money or at least scouting trades. I mean, from finding bull and bear traps to fading key levels, all of these things are the way that algos, institutions, big money traders engage the market, and that's why I love the PivotBoss Pivot so much. It's just a tool that you can use in so many different ways. I call it the Swiss Army knife of trading indicators because it can be used in so many different ways to help you in any time frame, in any instrument, regardless of what you're trying to do. I mean, it's just a phenomenal tool that can help you in any case. So I hope you continue to engage the market with PivotBoss Pivots, and I look forward to helping you make money with them in the future in the PivotBoss Trading Room. All right, everyone, have a fantastic rest of your day, and I'll talk to you soon. Take care.